Good morning, good afternoon, good evening around the world, wherever you're zooming in from. Hi, I'm Doug Brunke. I'm the founder and CEO of Global Chamber, and we're really pleased today to get a glimpse of the future. So we're going to be speaking with Carl Shimada. He is the Chief Market Strategist for Cambridge Global Payments. And because of that, he has his finger on all the things that are going on around the world. You as a business owner, or you as an executive, or you as a member of the global tribe, we know that the world is changing rapidly. We've seen a lot of things happen. I was just looking at the GameStop stock price a few minutes ago. It's coming down pretty rapidly today. It's certainly created some interest in some of the risk that's involved in doing global business. And so for all of us, our goal is, how do we get the global tribe to be more successful? And part of that is understanding what the risks are and managing accordingly. So who better to talk to than Carl? Carl, we really appreciate your conversation today. We're going to go somewhere around 45 minutes of information. We'll have a little bit of time at the end for your questions. And so those of you participating, I would suggest typing your questions into the chat area. And if we don't get to them, we'll handle them in a blog post. Carl, thank you for taking the time. I know you're a really busy guy, and we're ready. We're sponges ready to learn today. So thank you for sharing your words of wisdom.
Well, thank you very much for having me. Thank you for that incredibly kind invitation and introduction. So we definitely picked the timing very, very well to talk about what we're going to talk about. We're really planning this session around the turbulence that we're seeing in markets and in the global economy, how policymakers are interacting with all of it, and what to expect next. And the explosion that we've seen in companies like GameStop and cryptocurrencies and things like that recently really sort of underlines the fact that there are some changes happening under the surface that we should all be aware of. I guess two sort of housekeeping items before I get started. The first is that I am going to speak very, very quickly and go through a lot of charts very quickly. So what we'll do after the fact is if you do want to review any of this at length and at greater detail, just shoot Doug or myself a note, and we will come back and share the presentation with you. And the other thing is that you may hear at some point my puppy decide to speak up. I'm one of those COVID cliches, and I just recently got a new puppy, and she has some separation anxiety. She definitely does decide to talk if she doesn't see me for a little while. What's kind of funny about that, and I just thought of this, is that that's kind of a metaphor for what we're going to talk about. The fact is that this puppy and I have had lots and lots of interaction in the last 6 months or the last 3 months that I've had her, and it's really abnormal level of interaction. She's been able to essentially see me in the same room for months. And this is sort of what is happening in the global economy. To some extent, we have all the participants in the global economy have been very much in touch with policymakers, very much in touch with governments and central banks over the last year. The policymakers have been really sort of setting the tone for what we see in the real economy. So what we're going to do here quickly is sort of provide a snapshot of where the global economy stands and where we expect it to go next, and then go through this sort of interaction that we're seeing between policymakers and the businesses that many of you represent, and work through some of the implications there. So first thing I wanted to kind of highlight is that when we look at the global economy right now, we remain under social distancing restrictions that are very, very close to the peak that was reached in April last year. So governments around the world, particularly in the advanced economies, have responded to the second and third waves of the COVID pandemic by tightening restrictions again. And this has had a pretty deleterious effect on global economic growth. So a big rebound in the autumn last year has been followed by a bit of weakness in the Euro area, the US, and other advanced economies. But we do expect this to begin to ease in the coming weeks. And I mean weeks, not months. Even over the next couple of weeks, we expect many of these social distancing restrictions to begin to be lifted. With infection rates dropping, we are seeing, the case for people going back to work, for going back to school, and restarting economic activity. But we also have the fact that we have vaccines being distributed quite rapidly and accelerating over time. I live in Canada, and we're kind of doing a pretty slow job of it. But if we look at the biggest economies in the world, within the US, the Euro area, we are beginning to see a real pickup in the rate of immunization. And so this is essentially putting light at the end of the tunnel for many, many economic participants. It's helping households to plan for the future. Households are beginning to think, the end to this is in sight. We are going to be able to go back to work, and therefore we should be able to go out and do a little bit of spending. Businesses are doing the same. Businesses are investing in the anticipation that they're going to see demand in the future. And that is coming on the back of a very, very interesting and unusual dynamic in the real economy. And that is that due to the stimulus efforts launched by governments last year, we have an enormous amount of pent-up demand and pent-up savings in many of the advanced economies. So the handouts that governments engineered and handed to people have largely stayed in bank accounts or on the sidelines. And that means, and that comes on top of the fact that spending had not recovered. In other words, if you were looking to buy a refrigerator, a new car, anything like that, you likely put it on hold last year and you waited until this situation rectified itself. So what we've had is a really unusual situation in which we have a big bounce in the upward line, which is showing the amount of income that individuals are receiving from employment and from government. And on the bottom, the amount of demand or spending that they're doing in the economy have actually diverged. And what we're expecting in the coming months is that those two converge, that households begin to spend more and draw down on the savings that they have essentially put in the bank over the last year. This is a very, very positive sign. It is, I guess, how shall I put it, reinflating global economic prospects and creating a dynamic in which we see much brighter things in the future. And you can see this in trade. So trade remains relatively weak in some senses, particularly in the services sectors. But when you look at the amount of goods crossing oceans, it has exploded in recent months. And I think probably the best way to look at this is to look at the cost of shipping from China to Europe and the US. And you can see on the right-hand side of the screen there, a explosion in prices for shipping containers across oceans in the last couple of months. So what this is really on the back of is the idea that that households are consuming more and businesses are stockpiling more in anticipation of a rebound in demand in the early spring. So what you're looking at here is a very, very positive picture, I think, for the global economy, a suggestion that the underlying real economy is very likely to rebound in the coming months, and that we're going to see a relatively strong snapback from where we were last year. However, as John Kenneth Galbraith once put it, the only function of economic forecasting is to make astrology look respectable. The reality is that it is very, very difficult to forecast the future when it comes to economic developments. And I think one of the concerns that we have at this point is that the pandemic will become less important over time, but the hangover, sort of the hangover over the binge of stimulus that was poured into the global economy last year, that hangover could last for years. And so we need to think about how that might impact economic growth, how it might impact the businesses that you operate in, and what the long-term outcome might be. So with that said, let's talk about how policymakers have been intervening in the economies over the last couple of decades. First thing I wanted to kind of highlight is that the most strictly managed economy, I guess, in the world would be China. I put this chart together, and it's kind of complex to interpret. But what it does is it shows the amount of variance that we see in GDP numbers in China versus your other major economies. And you can see that China has had much lower variation over time, going back to 1996, and increasingly lower and lower variation. And so this suggests to me not what I think a lot of Western observers think. A lot of Western observers believe that China is making up its numbers, that these GDP numbers are fake. I would suggest that they aren't. They're quite real. But what they reflect is a government effort to keep growth very, very steady over time. So whenever we see a crisis hit, whenever we see weakness in the global economy, a drop in export demand that challenges the Chinese economy, policymakers in China launch a credit stimulus effort. They pour cash into the banking sector. The banking sector then makes loans to local governments, which build infrastructure, and to businesses, which build new factories and invest in plant and equipment. And so what we see over time is that during periods of relative weakness, China manages to keep the economy quite stable. The problem, of course, with this is that doesn't mean that that the money being spent in the economy is being targeted efficiently. What we should see in economies over time is a cycle of what some call creative destruction. In other words, we should have an economic cycle where there is pain sometimes, where old things are essentially wiped out and new things are allowed to grow. So the Chinese government, to some extent, although it is keeping growth very, very steady at very, very high levels over time, may be participating in a misallocation of capital. In other words, they may be investing in the wrong things and depressing the long-term productivity gains of the Chinese economy. In the Western economies, we did not see anything close to that until very, very recently. And here, I just kind of wanted to highlight how this looks from a debt to GDP perspective. So what we're showing here is that debt in the advanced economies is now poised to top the level that we reached just after the Second World War. And this is on the back of a concerted effort to provide stimulus to the economy, to provide direct payments to individuals, to provide, I guess, safety and security to businesses, and to stabilize the financial system. And so, to some extent, what we're seeing in the Western economies is a convergence with how the Chinese economy is managed. And I want to sort of, I guess, take a step back here to emphasize that the policymakers involved here, the politicians who are making these decisions, who are pouring cash into the economy, are doing this, I think, from the best of intentions. They're trying to stimulate the economy because they want to avoid long-term damage. They want to avoid what economists think of as long-term scarring in the economy. And this is a very, very good effort and very worthwhile, but it can create some, I guess, misallocation and some inefficiencies in how the economy functions. Central banks are engaged in a very, very similar effort. So you can see here interest rates plummeting in recent years, and particularly, I guess I should highlight here that we were beginning to see interest rates normalize until the pandemic hit. And then they plunged again, and quite frankly, I mean, we're below zero in some areas of the global economy today. We are at the lowest levels of interest rates in human history, by a long, long shot. I do have another chart somewhere that shows back to Hammurabi's time, the interest rates that were in place, and we have never ever seen something quite like this. So very, very low interest rates, and increasing intervention by central banks in the economy. Here's balance sheets at the major central banks, absolutely exploding in 2020 and continuing to grow in 2021. And so, in essence, here we have both governments and central banks intervening in markets and in the general economy to lift growth and stabilize expectations for the future. The other big step that has been taken and it has been sort of increasingly used is the use of swap lines. Sorry. The Federal Reserve has stepped into global markets to provide dollars to other central banks around the world. And so what's happening here is that during repeated events in the global economy, everyone wants dollars. And when they want dollars, there's a shortage because everyone's looking for safety at the same time. And so the Fed has increasingly acted against that. When everyone wants dollars, the Fed provides more dollars, and effectively sort of saves the global economy in doing so. In parallel with that, last year the Fed decided to adopt a new, I guess, mandate and a new approach to setting monetary policy. They adopted what they call an average inflation targeting framework, in which they said, essentially, we're going to allow the economy to run hot. We want the economy to rebound very, very strongly and to rebound for many, many years, and to generate employment growth before we begin to raise rates. So they told markets we're not going to raise rates. And even if we do see growth, and we began to see an interesting dynamic in global markets as a consequence. So interest rates plunged well below the 1% level on a 10-year basis. And even as inflation expectations have risen, so that's the green line there, interest rates have remained suppressed. So this is essentially guaranteeing to the global economy that we're going to keep policy loose, that there's going to be lots and lots of dollars available at low cost. And if we do face another crisis, that the Fed stands ready, willing, and able to provide more dollars. And so what this has done is it created an interesting dynamic in the foreign exchange world. So this is admittedly a really simplistic looking diagram compared to the things that I've shown so far. But this is really explanatory when it comes to explaining what the dollar does in different growth regimes around the world. So during times when the US is weak and the world is weak, we tend to see a stronger dollar. People seek safety in the dollar. They seek the opportunity to park their savings in the US, and so the dollar tends to rise. When the rest of the world is growing relatively rapidly, the dollar tends to fall because investors borrow in the US, they borrow from pension funds, they borrow from the markets, and they invest elsewhere. And so we see an outflow of currency out of the dollar and into the rest of the world. Very, very natural. And on the right-hand side, we see a situation when and this was prior to 2008, when the US was growing extremely rapidly, we knew that the Fed was going to tighten policy, interest rates began to rise in the US, and therefore we saw a stronger dollar. So pretty much before 2008, this explained almost everything that you saw in foreign exchange markets. If the world was relatively weak, we were tending to see the dollar strengthen. If the US accelerated past everyone else, we saw a stronger dollar. But during normal times, the dollar tended to fall. Now, post 2008, we started to see this change a bit. So everything else remained intact, but the Fed had said, we are not going to raise rates very quickly. We're going to stay on hold for a long period of time. You guys may remember the ZIRP policy, or zero interest rate policy, being held in place for a long time. That idea started to compress the smile. So we saw the upper side on the right hand corner of the smile get compressed. In other words, even if the US began to accelerate, we did not see the dollar rally. The dollar sort of was capped. This ended when Ben Bernanke said that he would begin tapering monetary policy and begin tapering the purchases that the Fed was making in the markets. And we saw everyone jump back into the dollar, and global currency markets fell. So the dollar jumped, global economic growth slowed down, and we saw lots and lots of turbulence. So the Fed sort of learned from that, and they said, post pandemic, what are we going to do? We're going to hold policy for even longer. We're going to avoid tapering. We're going to avoid thinking about raising rates, as Chairman Powell put it last year. And so what this did was compress that smile even more. Now, this did a really interesting thing for global economic participants. What it essentially meant is that you can borrow in the US and you can expect that for a very, very long period of time, interest rates are going to remain low, and the exchange rate is going to remain relatively low. You're not going to be too worried that the dollar is going to suddenly rally because the Fed is raising rates. So the big risk that used to sort of hang over the heads of global investors, of people who borrowed dollars in the US, that has been somewhat erased. And so you're seeing a very profound effect on the markets. This is sort of one way to look at it. This shows essentially what markets are pricing in terms of the probability of a 20% or more drop in the S&P 500 over time. And so you can see that in 2008, it took a while before markets became somewhat calm and unworried about the future. It took years and years for people to stop thinking that the S&P might fall 20% in the next month, year, or next 10 years. And then you can see that sort of long drag where volatility's expectations kind of steadily fell. 2020, we see a very abrupt spike at the beginning of the year as the pandemic hits. But once the Fed steps in, the Fed manages to suppress those fears. And what happens is that investors suddenly expect that markets will remain stable for a very, very long period of time. So this is creating some risk-taking behavior. We're going to discuss this a little bit later, but this is clearly suggesting to investors that they have the backing of the Fed and other central banks and governments. Investors at this point are feeling warm and fuzzy. We can put it that way. They believe that policymakers are there to help them if we do see weakness. And what this means for global money supply is that banks are able to create more money than ever before. They're more confident that the future is going to remain very, very stable. And so this is something that I think a lot of folks don't necessarily understand if they're not embedded in economics all the time. Central banks do not create money themselves directly. Commercial banks do. So commercial banks create money when they're making loans. They create money essentially out of nowhere and push it into the economy. And so banks only make loans when they are confident that they are going to be repaid in the future, and that they will not suffer loss in terms of the return on the loan that they have made. And so by suppressing volatility, policymakers have achieved a ignition of money supply in the global economy. All of a sudden, we have your major economies generating lots and lots of cash and pushing that out there. And so this is helping to lift global asset prices. It's also creating a situation that is very near and dear to foreign exchange traders. So foreign exchange traders are long familiar with a dynamic in which we borrow in one country. So we borrow, for example, in Japan at 0.1%, and we lend into Brazil or Australia or somewhere else at 3 or 4%. When we do a transaction like that, we can generate very, very large profits, particularly if we use lots and lots of leverage. So what policymakers have essentially done here is suggested to many, many participants in the global economy that you can borrow dollars and not risk a major jump in the amount that you have to repay at the end of your borrowing. And as a result, we're seeing increasing flow across borders in terms of financial transactions, and we're seeing increasing leverage across the global economy. And I kind of want to underline this. We'll talk about this a little bit further later, but essentially, if you have a mortgage and you're in, Canada, Europe, pretty much anywhere in the global economy, you have a dollar short position. Sorry. Because most of the funding for mortgages globally is done in US financial markets, when you roll over that mortgage, you are exposed to the cost of doing that funding. In other words, if interest rates in the US have risen substantially, or the US dollar has risen substantially, you're at risk. If you're a Australian coal exporter and you're exporting into the global economy, you're also short dollars. You can kind of go through the list of virtually every market participant, every economic participant is exposed now because the world is borrowing in the US and investing elsewhere. And this is growing bigger and bigger over time. The other big issue is sort of the nature of how this stimulus is working. James Grant said, capitalism without financial failure isn't capitalism at all, but socialism for the rich. And I think this is very, very true. And you can see the signs all around you at all times. The folks that have really benefited from central bank easing and from even government stimulus have generally been those at the upper end of the income pyramid and those who are better placed from an economic connection perspective. So just a couple of charts to underline that. Here are your big tech companies outpacing the rest of the world over the last couple of years, and particularly during 2020. So these are the companies that have the ability to scale up, but they're also the companies that have the greatest ability to borrow on financial markets and invest in their own stocks. And so they're clearly outpacing everyone else. Absolutely dominating the global economy at this point. Just to put that into perspective, the market capitalization of the tech companies today rivals the vast majority of the countries on the planet. The market cap is bigger than annual GDP for the vast majority of countries, and is only apparently getting bigger. At the same time, businesses in the real economy, the businesses that many of you represent and that you deal with every day, are distressed. Smaller businesses, according to the OECD, are under severe stress, and many of them will fail in the coming year and coming 2 years, simply as a result of pandemic shutdowns and the inability to access cash. So, you have really a dichotomy there. From an individual perspective, we have the same dynamic. So this is just one way to show this, but the top income quintiles, the people who have the highest income in American society, typically are able to save a much larger proportion of income every year, and therefore they are the ones that have money in the markets. So when markets go up, they tend to benefit the top stratum of American society and not the bottom. In fact, the bottom is steadily going into debt. So what is happening here is essentially, as the markets go up, the markets are lending cash to the poorer parts of society. And this is just, because the US does have great data on this, but we're seeing this on a global basis. The reality is that the people invested in financial markets in virtually every advanced economy are overwhelmingly those in the upper end of the income pyramid. So although government stimulus has really helped a significant segment of the economy, it is overwhelmingly accruing to the people at the top. It's also creating what I like to call access capitalism. So we're in a situation now where the overwhelming dynamic in the economy is that people who have access to others, who have access to people in power, are able to access cash. This is no longer an economy that is driven necessarily by inventing the best new widget. You have to be in the right place at the right time and know the right people in order to generate growth. And this is a breakdown showing the share of North American venture capital deals that is done in different cities around the US and Canada. And you can see that overwhelmingly we're focused on the Southern California and Washington and Boston, right in that corridor. So, essentially what you're looking at here is that if you are in the middle of the country, you probably aren't able to access cash in the same way. You might have to go to a banker and not access as much cash. This, I think, is playing a role in increasing political uncertainty. People are becoming more uncertain about what governments are going to do in the future. And the reason that they are is because voters are getting angry. They know that that the elites are participating in a lot of these gains. They know that this is not accruing to them, and they are expressing themselves at the ballot box. Everything from the Trump election to Brexit has an ingredient of inequality and discontent at its core. And so, I think we need to recognize that that this I guess, how do I put it, best intentioned effort to stabilize the economy is actually entrenching the position of the wealthy and the politically powerful. And as a result, we're actually creating instability. Robert Barbera put it very well a while back. He said, the last five, sorry, sorry, talking too fast here. The last 5 major global cyclical events delivered recessions, either global or regional. In no case was there a significant acceleration of wages and general prices. In each case, an investment boom and an associated asset market ran to improbable heights and then collapsed. From 1945 to 1985, there was no recession caused by the instability of investment prompted by financial speculation. And by the way, the only one before that was 1929. And since 1985, there has been no recession that was not caused by these factors. So he wrote this just after the global financial crisis and before the pandemic hit, but he was really underlining something here. He was suggesting essentially that the tail wags the dog in the global economy now. He was saying that when the financial markets become unstable, we then eventually see instability in the real economy. It begins to affect us at a real fundamental level at some point. And so let's talk about what we're seeing out there. And Doug, I think, really highlighted some of this at the start. So, firstly, the number of zombie companies in the US is rising over time and is rising globally. The number of companies that are earning profits that are less than the amount of interest that they pay is increasing over time and has gone well past the levels that we saw back during the dot-com boom. So, essentially what we have is companies that are not financially profitable, but are remaining in place and growing over time. We have real estate prices going through the roof virtually everywhere. Here is the change in residential property prices across many of your major economies going back to 2000. This is only accelerating over time as investors look for yield and look for a place to park cash. Debt levels are soaring once again. So in the US, after a deleveraging post 2008, household debt levels have risen again and are spiking upwards in many other advanced economies. And so what essentially is happening here is that investors are lending money to banks. Banks are lending money to individuals, and individuals are spending the money. All of this flatters GDP in the short run. It makes activity look really, really strong and robust, but unfortunately comes with the downside that the debt level underlying all of this is going up. This is not a productivity gain. This is not gains that are being generated through increasing activity in the real economy. This is gains that are being achieved through borrowing. speculative activity has gone through the roof. And, it's kind of interesting because I've always been a student of financial bubbles. And I really liked watching China at one point. So over the last decade, we had bubbles in China in things like copper, in caterpillar fungus, in Muay Thai, which is a form of Chinese liquor, all sorts of things as a result of the way the economy was run. We're seeing something extremely similar in Western financial markets today. And I should mention as well, so when Hong Kong trading was first opened up to the mainland, we saw lots and lots of bubbles based on companies that had lucky numbers in their names. And so today, we're seeing almost the exact same dynamic in Western markets. This is the share price of Signal Advance Inc. This is I believe, a telecommunications company of some sort, but it has seen a massive increase in price based on a very simple and totally separate factor. And that is that Elon Musk sent out a tweet saying, use Signal. He meant the e-messaging platform, not this company. This company has absolutely nothing to do with it. But investors piled in. So investors piled in, drove the share price through the roof, and they have not left. Although we've seen a collapse in the price, the reality is that the share price of this company is 5 times higher than it was prior to Musk sending that tweet, despite it being a completely separate company with no connection to what Musk was tweeting about. This suggests that we have a lot of money on the sidelines and a lot of people who are, I guess, bored. Cryptocurrency, similar dynamics. So, the idea that cryptocurrencies are scarce and hard to dilute has driven cryptocurrencies through the roof. And every day we're hearing more and more about these markets, and really echoes what we saw back in 2018 before the last collapse. Overall, though, the concern is that we are seeing a inflation in the financial assets held by individuals, and that echoes what we saw back in the .com boom, which you can see there. I don't know if you can see my mouse, but right here, this is a big bubble in the .com era. Then the housing bubble, we're now way past that. So financial assets have vastly outpaced growth in the real economy, and this suggests that at some point, if we do see a correction, we are going to impact GDP. We're going to see an impact on the real world, something to be concerned about. And then the last thing I kind of want to highlight here is that Hyman Minsky put it very well. He said, stability leads to instability. The more stable things become and the longer things are stable, the more unstable they will be when the crisis hits. Success breeds a disregard of the possibility of failure. So we're in a global economy today that has been perfectly engineered for the circumstances in which it finds itself. In other words, investors around the world feel that they are protected by central banks, by policymakers more generally, and they are making long-term investment decisions on that basis. And that's very risky because of one thing. The one thing is that we are all still very much tied to the dollar. So the US economy today amounts to roughly 15% of global GDP. 65% of reserves are held in dollars. 69% of trade invoices are in dollars. 75% of countries hold the dollar as an anchor, and the dollar is amounting to about 82% of currency turnover. We're all very tied to the dollar. If the dollar moves, we're very vulnerable. We're all essentially, as a result of this dominance of the dollar, lending money to the US. So when we recycle money into US Treasury bills from other countries, so if you're wealthy and living in an emerging market country and you're looking for safety, you buy a Treasury bill. If you're in Canada, you invest in US financial markets. When you push money into the US, you're actually widening the US trade deficit. And this is what many policymakers got wrong over the last decade. They were looking at the U.S. and thinking, the U.S. is lacking productivity. It is not generating revenue at the same rate that its competitors elsewhere in the world are. But the reality is that what was happening was dollars were flowing into the U.S. on a continuing basis, raising the value of the US dollar and allowing American consumers to consume beyond their means. And this mathematically drove the trade deficit. So just to sort of emphasize that point, putting tariffs on trade does nothing to this picture at all. All it does is move where you're buying from. If there's a tariff on China, that means that you're going to move your buying to Vietnam, but it won't mean that the trade deficit shrinks. So the issue here is the dominance of the dollar in global financial markets. But the interesting thing here is it's also put the U.S. into a banker to the world relationship. And I will admit that this is a very complicated chart. So on the vertical axis, it's showing the income that a country earns on its holdings in the rest of the world. And on the horizontal axis, we see the country's net international investment position. So this is essentially how much a country owns in the rest of the world on a net basis. And you can see here some very clear and obvious ones. So Germany and Japan have holdings in the rest of the world on a net basis. They own more of the rest of the world than the rest of the world owns in those countries. And they earn positive returns for that. They actually get paid for doing that. Then you have China. China is the opposite. So China has a huge positive stake in the rest of the world and the rest of the global economy, but is actually earning negative returns. So it is getting paid, it is losing money on lending into the US. The US is way over on the left-hand corner there, up to the left. The net international position, investment position of the US is something like $12 trillion. And it is actually earning positive returns. So what's going on here? The US is borrowing very cheaply from the world and lending back to the world. And in doing that, it is earning a profit. So it's like a giant hedge fund. Now, this seems like something kind of abstract, but what it means is that the rest of us are exposed. If we have borrowed from the US and the US decides not to roll over the loan, or we can't access dollars, or interest rates have risen, or the exchange rate has risen, we are exposed to loss. And so this creates a major fragility. And it's getting bigger over time because of the factors I kind of outlined before. The world thinks that they can borrow in dollars. Investors around the world and households and banks have borrowed lots and lots of money. So this is just a way to show this. This is non-resident, non-bank borrowers in the rest of the world borrowing from the US in US dollars relative to borrowing in yen or euro. And what you can see here is essentially an explosion in how much the rest of the world has to repay in the event of a squeeze on the dollar. This is triggering an interesting dynamic in markets. Whenever a shock hits, everyone freaks out. They buy the dollar. Freaks out is a technical term. But everyone buys the dollar back really quickly as soon as the weather changes, and we see a spike in volatility. We see the treasury markets seize up. We see asset markets around the world fall. So what's fascinating here is that today you see equities, Bitcoin, gold, everything else fall at the exact same time while the dollar rises. And this is happening on a more and more frequent basis. And I would expect that we're going to see it more and more frequently in the years to come. So for participants in the real economy, your real big concern here is how to mitigate that risk. And so at this juncture, I kind of want to highlight something Woody Allen said. He said, more than at any other time in history, mankind faces a crossroads. One path leads to despair and utter hopelessness, the other to total extinction. Let us pray that we have the wisdom to choose correctly. This might be what you're thinking at this point, that this is a really depressing outlook. It is not. What I really wanted to highlight here is that that we are seeing a change in our vulnerabilities, that it is not the real economy we need to worry about at this point, that it is the financial markets. So how do we manage that? I'll kind of highlight three things. The first is that it is very, very important to manage your currency exposures. When central banks are all at zero and have very little latitude to move, exchange rates are the things that are going to move. We're going to see exchange rates function as shock absorbers for the real economy. So volatility is very likely to rise in the years ahead. Now, the great thing about this is that if you are a participant, if you're running a business in an advanced economy, you have access to amazing hedging abilities. You can lock in your payments in the future and not be exposed to risk. And I think that this is a really good juncture for people involved in trade to think about using things other than the dollar. Because if you use the dollar in trade, you're actually still exposed to whatever happens in the exchange rate. If the dollar falls, you tend to see the value of the local currency rise, and you're exposed to volatility. You eventually have to pay that amount. So the fact that American businesses are sending dollars all over the world is a huge drag on the global economy. And it's a huge drag on individual businesses. If buyers and suppliers could get together and agree to exchange payments in local currency, wherever the supplier is, that they negotiate the transaction in local currency, they would be far better off. And the reality is that the financial tools exist to do this. So what I would like to see in the years ahead is that more businesses use local currencies and protect themselves. And therefore, we do not see this relationship that we see depicted on this chart. What you're seeing here is that when the dollar rises, global trade slows. What we want to do is see a reversion of this. And just one other thing to kind of highlight here is that while we're hearing all this depressing stuff, the reality is that the global economy is doing just fine. We're in great shape. We have more people on the planet today living better, longer lives, being more productive, and contributing to global knowledge in ways that they did not before. And just to sort of underline this, this is the share of gross world product by century, going back to 2,000 years ago. What you can see is a massive acceleration somewhere around the 15th century. This is when global trade networks really started to develop. I think Doug is the inheritor of a long tradition of this. This is, going back to Marco Polo's time. When we establish these global trade networks, we share ideas across the planet, and we see greater growth for everyone as a result. 20th century, we had a massive acceleration. So we had more globalization, we had more trade flowing across borders, and more growth than ever before. But in the first 20 years of the 21st century, we have done more than they did in the entire 20th century, more growth than they did in the entire 20th century. So we're actually accelerating. Betting against this would be foolhardy. You may hear lots and lots of negative stuff out there, but the reality is that the tide of history is going in one direction, and that direction is very, very positive. So it's just about managing your risk as that path or that trajectory takes you forward. And just to close out, as Orson Welles put it, in Italy for 30 years under the Borgia, they had warfare, terror, murder, and bloodshed. But they produced Michelangelo, Leonardo da Vinci, and the Renaissance. In Switzerland, they had brotherly love. They had 500 years of democracy and peace. What did they produce? The cuckoo clock. Reality is that all of this negative stuff that you're hearing about, all the volatility and turbulence and chaos that is afflicting the global economy, is actually, in general, a positive sign. It suggests that we are engaged in lots and lots of churn, and that things are improving in the long run. All right. So Doug, I hope that I was somewhere remotely on time there. I apologize for talking so long there.
No apologies accepted, because that was amazing. That was one of the best presentations I think I've ever seen on any topic. That was really good. I love the Woody Allen quote in particular, the utter despair versus death and destruction, which path to go. So I was wondering what the positive was until just the last couple minutes there, or maybe even the last minute or two, that basically what you're saying is all of this volatility, all of this danger, if you will, is actually a good thing. And so I'm still kind of wrestling with that in my head and what that really means. And so I come to the conclusion, which I think is what you were saying, is don't worry, be happy, and hedge your bets and manage currency exposure. I mean, what is am I coming to the right conclusion?
Yeah, I think that's it. And I think that the interesting thing in the coming years is going to be that as policymakers step back, as the Fed steps back, as governments sort of revert back to their historic roles, there's going to be a lot of concern about that. But I think that what they're really going to allow is the flourishing of creativity and innovation. And so sort of see the silver lining in the clouds, I guess, is the way to look at how things are going to evolve in the next little while, and obviously be very, very worried about where financial assets might go.
Got it. So in terms of some of the things then we need to be thinking about, do you have a crystal ball of how all of this might evolve then over the next several years? Or, I mean, I mean, do you have the crystal ball down to that level of granularity? What is going to happen, later this year as we come out of the pandemic? What is going to happen over the next several years on the global economy? Look, we're seeing China and India both roar back. I think India roar back, or at least I've heard that. Certainly China is already. We're going to see a lot more volatility, aren't we?
Yeah, I think we will. The key thing, of course, is that it will be sporadic volatility. It won't be consistent. You're going to see repeated sort of freakouts. One of the things that I think is a very clear outcome at this point is that at some point, or perhaps at many points, we're going to see concern about inflation come back. So, and I think everyone on this call really sort of has their finger on that pulse. The reality is that supply chains are very stretched at this point, and businesses are stretched. So they're going to have difficulty meeting demand for a little while. And that's going to happen just as we have governments continuing to pour money in, and financial conditions remaining very accommodative. So what we do need to sort of prepare for is those big spikes in concern about where inflation is heading. Longer run, one thing I would kind of highlight is that although, yeah, that the winners today might not be the winners in the long run. So, for example, China's kind of an interesting story right now. It looks like it's in great position because tangible goods have soared. Tangible goods demand. In other words, consumers around the world, because they could not consume services, were consuming tangible goods. But that's going to fade. At some point, we're going to have consumers shift back to services consumption. And when that happens, that's going to put downward pressure on the Chinese economy. And that will come just as, the inefficiencies that have been created by all of this credit creation come home to roost. So I would suspect that we see a bit of a rebalancing there, that that the idea of China taking over the world might look a lot like Japan Inc. did back in the 80s at some point. It's sort of hubristic to think that things are going to continue in a linear manner going forward.
Amazing that you remember that, because I lived in Japan right during that time. And at the time, the GDP for Japan was extrapolating over the US GDP. And so it was like, oh my God, Japan is taking over. And yet you've seen all of these different cycles. It's great to get your perspective. You're the first person I've ever heard that articulated in that way. So from a China Inc. perspective, you may be a little bit less bullish than some.
Yes. Yeah. And, to that point, so if you went into a bookstore in the 80s, everything was Japan Inc. and how Japan was taking over the world. At one point, the land under the Imperial Palace in Tokyo was worth more than the state of California, literally. So, and I'm sure you've walked around it. It's not very big. It was clearly a moment of excess. But the thing was that at the time, people were looking at Japan's GDP, and they were thinking, that all of this activity happening had to be productive, right? It was being measured in GDP. But the reality was that that credit bubble that had been created was funding the construction of railways that were totally useless from an economic perspective. Huge international airports that to this day have one or two flights that arrive each day. A lot of that infrastructure that was built at that time has essentially remained frozen in place ever since. And so, it's very interesting as an observer to look at this stuff and think, this artificial measurement that we do, this GDP measurement that we do, isn't necessarily reflective of what's actually happening. And what we really want to see happening is productivity. Is we want to see innovation happening. And I would suggest that this pandemic has been the biggest boost to innovation that has happened in our lifetimes. It accelerated everything. So, the fact that we're doing this call the way we are doing this call today is a very positive sign, and would suggest to me that, that expectation that the advanced economies necessarily fall behind forever is misplaced.
Brilliant. Yeah, I love that. I think that's exactly the right conclusion. We only have a few minutes, and we're going to wrap up before the top of the hour. So I would like, there's a lot of really good questions. We're not going to be able to clearly to get to all of those. So we'll follow up separately. I also want to make sure everybody realizes that we do have the slides, and we'll be sharing those to all the attendees. So fear not. I mean, there's a lot of really great information in there. In terms of, if there was one question that occurs to me that, if I could ask and get an answer on, is that given all of this volatility, certainly one of the daily fears, is that things are out of control and things are going, to hell in a handbasket like it has in other times. And so some of the inclination might be to kind of bury your head in the sand, but that's clearly not what needs to be done. And so as a business, what do you recommend to executives and business owners and others to stay informed, to stay calm, and just kind of be able to kind of manage through this? You alluded a little bit to surrounding yourself with the right people. You would be a great person to be surrounded with. But what else should people be doing right now to kind of get a grip?
Yeah, I guess I would suggest diversification is the key. So when we look at the opportunities in the global economy right now, they are not necessarily in the U.S. They're everywhere in the world. We should build the foundation to get out there. And your organization is a key component in doing that. Building those global trade networks, those are the things that are going to keep you afloat. And they're the things that are going to give you the leverage to growth in the future, right? They're the things that are going to give you the opportunity to capitalize on all of the things that come down the pipeline. The other thing is, diversification in the viewpoints that you read. So, for me, I use Twitter a lot, but I also use a thing called Feedly, which it's just a RSS feed. It brings in news articles from around the world, but I have everything from, the South China Morning Post to Al Jazeera to the Washington Post. And when you take all of those views together, you start to get a more balanced picture of what's going on out there. And, I think in the US in particular, the noise is just overwhelming, and it's so often heavily partisan. And I don't know if you've actually looked at this, but the crazy thing is in the US right now that Democrats think the economy is booming and Republicans think it's terrible. And 6 months ago, they thought it was the other way around. And that really reflects the fact that people are in these thought bubbles, right? And so to me, as a business person, you want to make sure that you're hearing the viewpoint that others have. If you're hearing something that you already agree with, that's meaningless to you. That's useless. You should be hearing from others. And again, I think that's something that your organization brings to the fore, right? That's the core of it, is to make sure that you hear the international perspective, hear what other people are thinking, and therefore, you're going to be able to make much more balanced decisions about what's really happening out there.
Oh, absolutely. I couldn't agree more. I love being compared, Global Chamber compared to Marco Polo, and kind of the implication of, kind of moving the world forward through a global trade. I hadn't made that full connection yet, so I appreciate that. How do people stay in touch with you? I know you've got a Twitter account for sure.
Yeah. Yeah. So yeah, spelling it out. Yeah, actually, maybe we'll just circulate that after the fact. But
Okay.
yeah, definitely email and Twitter is great. And I also, send a little newsletter with interesting articles all the time to a group of people. So, if anyone wants to subscribe to that, definitely happy to do that. And I should admit, though, right off the hop, that it's very nerdy stuff, very much like the presentation was. So you're sort of opening yourself up to that. But yeah, I definitely love to discuss this stuff and to learn from people who are on the front lines.
Awesome. So we'll get that information out to everybody. Do you have a Clubhouse account yet?
No, I don't. It was funny. I a bunch of contacts in mainland China sent connections yesterday, and I haven't actually had time to connect. But I think the thing's going to get shut down shortly, so I'm a little worried about that. But yeah, I think Twitter is a great place to have a dialogue and to. The amazing part is that you can connect with the world's experts on almost any given topic through Twitter. That's totally unprecedented in human history. So pretty fantastic that we can do that.
Fantastic. I saw, Ross, your comment about getting the quote unquote nerdy newsletter. So we'll make sure that everybody who's on the call will get, the presentation, the links to signing up and the Twitter account and all access to Carl all the time. Thank you so much for the today really spectacular presentation. I'm moved. I need to kind of walk around now for a while and just let all of this settle in. And so thank you for getting us thinking about it, and thank you for getting us to appreciate the fact that volatility and change is good. And I totally agree with that. I think we're seeing that, and we're on a kind of a cusp of something really great going forward. Thank you very
Absolutely.
much for your time, and we'll talk to you again, I hope, soon.
Absolutely. Thank you very, very much for having me.
Our pleasure. Spectacular, as Dwayne says. I agree, Dwayne. Take care, everybody.